So Oakville Condo sells for a $237,000 loss, 36.1% loss. That is huge. It was $1.6 million, now $1.1 million. And this is an $825,000 loss essentially over the 2022 price. Canadian home prices are absolutely collapsing. And in this video, I'm going to take you through all the evidence of that and show you why this could in fact just only be the beginning of a massive collapse, which eclipses the financial crisis in 2008 in the United States, where some markets went down over 60%. We're already starting to see the cracks, and that in fact happened. So first of all, I just want to walk you through what is happening with mortgage renewals. This is very important and was posted on Twitter by Hanif Bayat. Sorry if I'm butchering your name there. But you can see over the next 1 to 2 years, there is a hell of a lot of mortgages that are going to be renewing. And this is the problem. A lot of the people who took out these mortgages couldn't afford them back then. They were overstretching themselves back then when they took out the mortgage. They could barely afford it. And now they're just completely unaffordable. There's absolutely no chance. So a lot of those people, they're beginning to list their house and try and sell it, anticipating that renewal, knowing that they're not going to be able to afford it. Some are downsizing. Others are just trying to get into the rental market and sell out completely and cash in if they're at one of the markets which is still at the peak, like in places like Calgary, Edmonton, Halifax, Nova Scotia, those places that still have the remnants of hysteria in the market. So it's very interesting when you look at these stats. So TD 19.3% renewing over the next 1 to 2 years, 24.6% at Scotiabank, Desjardins 22.2%, CIBC 29.4%, BMO 21.5%, National Bank 21.6%, and finally RBC 25.3%. But even if you look at over the next 6 months, it's still a substantial amount. Over the next 6 months between May 1st and October 31st, 2024, you've got 6.7% renewing at TD, 8.1% at Scotiabank, 8.2% at Desjardins, 9.5% at CIBC, BMO 5.2%, National Bank 8.1%, and RBC 12.8%. So obviously this is going to have a massive impact when it comes to real estate prices, because when you think about what's really going on, you've got a lot of people that are going to be unloading because they simply cannot afford the payment increase. Like, they cannot qualify to renew. And those lenders that aren't going to credit check people and are just not going to bother with appraisals and everything like that, those lenders are going to pay the price for that in the end. I mean, if you don't credit check people when they renew their mortgage, you're the fool. You might think, oh, that's great because the person who took out the mortgage is just going to be absolutely fine. But if they don't qualify for that mortgage that you're giving them, it creates a huge problem, exactly like we saw during the global financial crisis. You just have more and more subprime building in your prime, supposedly, mortgage portfolio. So anyway, lower mainland home sales dropped despite Bank of Canada interest rate cut. So obviously we saw all this narrative that came forth from the real estate industry that when the interest rate cuts start, the prices and the market is just going to explode everywhere. And we've actually seen the opposite of that. Sales are down. So if you look at this, for example, with Vancouver, despite the Bank of Canada cutting its prime interest rate last month, the Fraser Valley Real Estate Board and Greater Vancouver Realtors say it has done little to kickstart home sales in the region. The region recorded 1,317 sales in June, down by 13% over the previous month and down by more than 30% over 2023, which is really interesting, you know, because you've still got markets that might be topping, possibly still a lot of hysteria around the markets like Calgary, and the fundamentals are closing in on Calgary as well. The unemployment rate now at 8.5%. And I just want to highlight here, just imagine in Calgary if the real estate market flips, because you're going to have that unemployment rate going to north of 10% in very, very short fashion. So it's very interesting what's going on. And obviously, if you've got places like Vancouver that are slowing down and you are saying that the narrative is true and it's all the people moving from other provinces, but if their markets are slowing down drastically, that's eventually going to feed into your market. And once that self-reinforcing cycle of a bubble is interrupted, that's when the whole market just rolls over essentially, because it can't sustain itself and the economy economy tanks because you haven't got all the people that are coming and they're buying cars, they're buying furniture, they're getting people in to do different things on the house that they just bought. Because when you have a market like Edmonton where there's a lot of hysteria, guess what? That actually does impact the economy until, like I said, it's interrupted and then you have major problems. So very, very interesting what's happened there. When you look at prices right now, obviously they've come down. It's going to be very interesting to see what it looks like over the next couple of quarters when this chart is, of course, added to, because this is real residential property prices adjusted for inflation. As we've discussed many, many times, that's all that matters. When you look at where this bubble started around 2003, 2004, where mortgage debt started to leave the historic trend line. Obviously, income wasn't growing at the pace of mortgage debt, so you knew it was a bubble. And then finally in 2020, it just went absolutely parabolic. This line practically went vertical, and that's where you saw mortgage debt just completely not correlated to any fundamentals out there at all. But it hasn't been correlated to fundamentals since 2004. People's incomes haven't been growing. When you look at GDP per capita, we've just erased a decade's worth of growth. So anyway, let's get into what's happening here with some of the staggering losses that we're beginning to see. So Shazzy, you got to check him out on Twitter because he just put some unbelievable stuff on there, which really shows you what is going on in the market and some of the unbelievable losses that people are taking. So Oakville Condo sells for a $237,000 loss, 36.1% loss. That is huge. And that is nominal, guys. So when you're talking about real adjusted for inflation terms, you're talking about over 50, 60, even 70%, depending on where you think inflation is. And remember when the real estate industry back in 2021 was saying that real estate was the greatest inflation hedge? I mean, I have no idea where they got that from, because obviously it's incredibly illiquid and it's based off leverage in places like the United States, the UK, most of Europe and Canada. Extremely so in Canada, we know, with the amount of household debt that's out there. So obviously when something's based off leverage, it's not going to be correlated to inflation anymore. That only actually works if you're talking about a mainly cash market, which is not Canada for sure. As we know from looking at the mortgage debt chart, we can see that it's not. So they took a 36.1% loss. Like I said, if you think this isn't a housing market crash, you have to get your head checked out, and we'll go through many more examples now. So a $238,000 loss on a condo bought at the height of the market. So it sold at a 33% loss. Again, real terms, you're probably talking around 50% at least. Reduction in the person's purchasing power who put money into this condo in 2022 is now taking their money out, and it's worth 50% less, because what they can buy with that money in the real world, not using the CPI, has gone down by 20, 30% at least, plus the reduction of 33% in their capital from investing in the real estate bubble. So very interesting. And then you've got B lender blowout, and we really have to talk about these B lenders as well, because they are a massive risk to the financial system. So after buying this house for $2.35 million at the end of 2022, the investor almost immediately tries to rent it out for $7,000. And of course, nobody took it at that price because nobody could afford that price. Your market for the person who can afford $7,000 a month is slim to none. Obviously, they didn't do any research on that. The average incomes in the area, the median incomes. He then tries to flip it for $2.4 million. No takers. After several price reductions and relists and offer nights, the B lender took over the property, power of sale, and couldn't sell it. This is the second attempt after a price reduction of $400,000 under what he paid. So you can see here that it was sold for $2.325 million there, and now it's being listed for sale for $1.899 million. So it is crazy the loss that people are taking, just huge losses on these houses, condos, townhouses. So this is the Oshawa obliteration. So bought at the height of the market in 2022, the buyers took out a whopping $1.4 million loan with more than $10,000 a month in monthly payments for this house in Ottawa. The B lender, River Rock, stepped in April of this year and served them with a notice after they defaulted on their March payment. The home finally sold for $800,000, what they paid for it. It seems that some of the B lenders have very little patience with delinquent borrowers. And it's no wonder that that's the case when you really think about what's happening with these MICs and these B lenders. It's because essentially they're having a lot of the people that provide the capital for these mortgages ask for their money to be ejected because they can go and put it in a Federal Reserve bond and they can get over 5%. So the risk reward for these higher interest rate, higher risk loans is just not there. And especially since when you look at what's happening with the market and its deterioration, that's also putting their capital at risk as well. Because as we can see, some of the losses that are being took here, they're not small amounts of money. These are big amounts of money. And we're not talking about $300,000-$400,000 homes. We're talking about homes in the millions of dollars. And we know that the risky mortgages boomed during 2021. And that was part of the cause of leading to that massive melt up that we saw, was a rise in the amount of risky loans that were being issued. You got fixed payment variable rate loans that were extremely risky. And you've also got all the boom in MICs and these mortgage corporations. And just remember, guys, when you see those default rates that the mainstream media is constantly quoting, those are based off the big five banks. Those don't include all the MICs that obviously we know have a much higher default rate, and they don't have to publish it either. So the amount of defaults could be actually way higher than people actually think. And that still leads to a massive amount of listings coming on the market and huge price cuts, as we're seeing these lenders will take, because they just want to get their capital out of the deal. So nightmare in North York, freehold townhome prices are imploding after the developer slashes massive $500,000 off the list price. So obviously immigration is not really helping with this, guys. And that was a joke, by the way. You know from watching my channel that I am not one of the people that thinks immigration drives the housing market. I think that's ridiculous, with the disclaimer obviously that immigration does have impacts on the speculation in the housing market, but it's definitely not a direct impact. So anyway, when you look at what's happening with these actual new construction townhomes, you're seeing massive discounts. So this was posted to the assignment Facebook group, and you can see that they're saying that there is a massive discount here. It was $1.6 million, now $1.1 million. Again, who can afford that on the median household income in that area? Probably such a limited pool of people. And the only people who've been able to afford to operate in the market over the past 2 to 3 years have mostly been speculating. And that's the problem when you're in this hyper bubble. Some people think it has strength, but they actually mistake the strength just for the hysteria and the amount of speculation that is going on, and also the risky loans, which in layman's terms just means more people operating in the market if you've got more and more risky loans that are being issued. So this is a $2.3 million lawsuit for failure to close. I mean, this is just a horrifying story of what can happen when you try and walk away from a contract of purchase. And I think a lot of buyers have been doing this, because it's not just this story that Shazzy put out. I've seen many stories of buyers trying to walk away from their home purchases because, you know, down the line they realize, oh, the market is flipped. Now prices are coming down. It was stupid. Why did we pay so much over the asking price for this house? And they have this regret. And then the buyers go after them because that's their right. They can, for breach of contract. Now, are they likely to actually recoup the amount they're seeking there? No, probably not. They've probably got like a 10% chance of actually getting that amount of money back, because in all likelihood, you'll see a lot of buyers that will just declare bankruptcy. Because when you think about it, most of the money that was going to be provided for homes like this was being provided by the banks, not the buyers. So they don't have the $2.3 million for this house. But it's very interesting what's going on. Very sad situations for a lot of different people of what's happening. So this home was eventually sold for $1.45 million, but initially it was sold for $2.3 million, and that's where the buyers walked away, and then it looks like they leased it out for $5,000 a month. And this is an $825,000 loss essentially over the 2022 price. And you've just got to think, we're talking about Cambridge, you know, really nice house in Cambridge, would have been one of the houses that a lot of people would have been looking to move to during the pandemic when everybody was overstretching. They were looking for bigger houses. They were looking to get out of the GTA. And a lot of people said, you know, I don't want to sell my condo back in Toronto because that's a gold mine. Home prices only go up. So then they go out and take a riskier loan from like an MIC because they think interest rates rates are really, really low, and the brokers are just happy to write them a mortgage with a massive amount of fees, which is variable. And then boom, they're in a hell of a predicament. When rates go up, their lender might not even want to renew with them, so then they got to try and sell it, and they're looking at an $825,000 loss. I mean, there's probably about a 1 or 2% chance that the person is going to have that money in Cambridge, but you're going to see this happen all over the country. And even those markets that are hot right now, like Calgary, Edmonton, Halifax, remember that they depend on markets like the Vancouver market and the Toronto market. So basically, a lot of the hysteria and euphoria in those markets is because you've got people who are clueless, essentially, moving from other markets thinking, oh, wow, the prices are a lot lower here, but they have no idea why that's actually the case. And then they go in and buy. And I've seen many examples of this. And right now you've got the rental inventory skyrocketing in Calgary and Edmonton. And you've got prices on rents, especially in single family homes, that are declining in Calgary and Edmonton. And as you know from the video I did, when you look at a property's value, you calculate it based off the rent. So obviously if the nominal prices are going up, rents are going down, then that just means you're more and more in that bubble territory. You're more in that risky territory, because obviously if the person can't sell the house for whatever reason, they can't rent it out to cover their costs or even near to their costs. So it's incredibly interesting what's going on with the dynamics, because as these markets slow down, Vancouver is mainly affecting obviously Calgary, Edmonton, and then you've got Ontario that's mainly affecting Halifax, Nova Scotia, New Brunswick, places like that. So a lot of people don't realize that those markets will impact those other markets in some ways. But in my mind, a lot of what's going on in Calgary, Edmonton, Halifax, New Brunswick is a lot of speculation. So yes, there's people moving, and that's a narrative that you can spin on the housing market being strong, but the majority of what's going on is speculation on that narrative, in fact. And that's what people don't realize is actually driving the market. They mistake the actual narrative for being the fundamental. And we see that time and time again. Just like the Bank of Canada cutting interest rates is going to make the housing market boom. So anyway, if you've enjoyed this video, I would highly recommend that you check out this interview with John Flynn, the last one I did on the podcast channel. And if you're looking for a VPN to protect your privacy, go to expressvpn.com/market mania. That's the affiliate link for this channel, linked in the description and the pinned comment. And I will see you in the next one. Take care.